They lied to us. I'm your host, Steve Metre, and thanks for joining me today. In our show today, this will shock the nation and the world. I'm going to show you what the government is going to release tomorrow morning, why it's going to show that the U.S. economy is in far worse shape than we thought, and how it explains why the market is on edge, because when this comes out, it's going to be outright shocking. Plus, we have a sponsor for today's show. I'd like to welcome Zafiro Methane. You can find him on the CBOE Canada under symbol ZEFI, and on the OTCQB under symbol ZEFIF. And they're an environmental services company who measures and tracks methane leaks, plugs wells in the U.S., and sells carbon credits, meaning they make money three ways, and you can make money too because they just IPO'd in April. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we find out tomorrow the Fed confronts up to 1 million U.S. jobs vanishing in a revision. That's right, tomorrow morning we're going to get the non-farm payroll revisions, and that means we're going to find out that the government has been overstating the number of jobs created. And remember, just a month ago, we found out just how keyed the stock market was to the labor market. Well, tomorrow it's going to find out things are far worse than anybody believes. Goldman Sachs and Wells Fargo economists expect the government's preliminary benchmark revisions on Wednesday to show payroll growth in the year through March was at least 600,000 weaker than currently estimated, or about 50,000 a month. While JP Morgan Chase forecasters see a decline about 360,000, Goldman thinks it could be as large as 1 million. And if you can imagine what that would do to investors and, of course, the Fed, it's going to rock the world in terms of its confidence in the U.S. economy, keeping the world out of a recession. And all it's going to do is validate what I've shown you over the past several months, is the U.S. economy is headed in the wrong direction. And there are a number of caveats in the preliminary figure, but a downward revision to employment of more than 501,000 would be the largest in 15 years and suggests the labor market has been cooling for longer and perhaps more so than originally thought. The final numbers will be due early next year, but the damage will be done now because, again, the belief is that the data is actually better than the government's reporting, that the U.S. economy is stronger than anyone believes, and that we're going to see the soft landing just delayed from what the Fed's projections were. This will change absolutely everything, and we already could see it coming. Let's take a look at the details here, because something we know about the non-farm payroll report, it's one of the most lagged data series out there. If we look at the weekly continued unemployment claims, which will have new data on Thursday, what we see is it continues this trend higher. Now, with the lag, the U3 unemployment rate, which is something we hear the Fed speakers talk about all the time. We heard recently Fed Chair Jerome Powell say that he believed that the peak was somewhere right around 4%. We're now at 4.3%. And of course, that means that the non-farm payroll reports, which have remained an outlier. You remember we've talked about this in the past, that the data is suggesting the U.S. labor market is weakening. And then all of a sudden we get this crazy good non-farm payroll report, but then they quietly downward revise the prior months. This time there's going to be no hiding it, because we're going to find out the U.S. economy created far fewer jobs than anyone thought. And of course, we know with a lag, the non-farm payroll report. Now, I'm showing it inverted here in blue on a year-over-year rate of change. Now, normally we show it in thousands of persons, but due to the pandemic, it just won't show correctly. But I wanted you to see the effect is where the unemployment rate goes in red, that the non-farm payroll report, again shown inverted, follows it with a lag. So what we're going to see here is some sharp downward revisions to the data, validating that the continued unemployment claims and the unemployment rate are actually right. In reality, the market wants to believe that they're wrong and the non-farm payroll report is right, which is why we saw the big hiccup in stock sell-off after the last non-farm payroll report. And then some other data came out and everybody said, no, that's just a one-off number. Everything's going to be fine. But this is going to change everything. And such figures have also got the potential shaping the tone of Fed Chair Jerome Powell's speech on Friday at Jackson Hole, Wyoming. Investors are trying to gain insight as to when and how much the central bank will start lowering interest rates as inflation and the job market cools. Now, we know this will have an impact on his view because it's also going to have an impact on the next non-farm payroll report. Now, remember, it's a lagging report, so it's designed to be smoothed out, but the real issue here is the trend. So even if we lose, say, 50,000 jobs that we didn't report correctly per month, what it means is the trend is still going down, and this is setting up to be a very poor non-farm payroll report next month, with the trend suggesting we could be negative in a matter of months. Will this have an impact on the Fed? Oh, you bet it will. Because when we look at the unemployment rate shown in red here against the federal funds rate, what you can see is when the unemployment rate starts to get out of control, the Fed is quick to cut. Remember, their dual mandate has them focusing on inflation and the labor market. They focus on inflation first because they really believe that they can bring inflation down without damaging the labor market. And this is something investors believe too. In fact, that's why we see a record amount of money crammed in at the highest concentration in 5 to 7 stocks, because everybody believes the Fed got this right. The problem is when you bring inflation down, you eventually start to impact the labor market, and sure enough, that's what's really going to set the Fed up to cut here. We can see here in the dot-com bubble, you notice the Fed held rates, and then as the unemployment rate started to rise, next thing you know, the Fed started cutting. And people who believe, and you'll hear this in the early stages of the Fed cutting rates, is that all we needed was a couple cuts. In fact, even the Fed will come out and say, you know, we may have over-tightened a little bit. This is going to unleash the economy. And maybe inflation won't go down as fast as we want, but we're going to stick this landing here. But what you can see in the charts, that's never the case, not one time, because as the Fed cuts, it's too late. Once you start putting people on the unemployment line and they can't find work, it tends to snowball out of control. And this time, we're setting for that up to happen again. A large negative revision would indicate that the strength of hiring was already fading before this past April. This is something we talked about as the economy was slowing. We saw this late last year and into early part of this year that something had materially changed. What we didn't see it was in the non-farm payroll report, but that's all about to change tomorrow morning. And that would make risks to the full employment side of the Fed's dual mandate more salient amid widespread softening in other labor market data, which would set up an absolute lock of a September rate cut. Now, will we get 2 cuts at once, a 50 basis point? That remains to be seen in how the data runs between now and, of course, the next Fed meeting in mid-April. But what we can say is why this is happening. And a lot of people don't understand, because when the Fed inverts the yield curves, when they drive short-term rates up higher than the market expects to get long-term rates, what it does is it curtails the creation of credit and money in the economy. And at some point, just like a game of musical chairs, you have more people than you have chairs. In this case, you don't have enough money to keep the employment market going, pay on all the debts, and hit your growth targets. And sure enough, this is what happens each and every time. You'll see here the yield curve is the 10 and 2-year. So when it's inverted down here below this horizontal black line, that means 2-year yields are higher than 10-year. And that's not normal. That's not how interest rates should be priced. But what you can see is when that happens, with a lag, the unemployment rate, shown in red, starts to increase. And you see it happen here in the late 1980s, going into the early 1990s recession. It happened again at the dot-com bubble. And with a little bit of a lag, it happened the global financial crisis as the Fed tried to get out of it, but it was too late. This time, we're facing the second longest and second deepest inversion of the yield curve, and nobody seems to believe that it has the powers it does in the economy. But the labor market is going to show this tomorrow when we get that data first thing in the morning. And if it's as bad as Goldman is suggesting, look for a very adverse reaction in the stock market, because remember, the market believes in the soft landing, that you can bring inflation down without a large sacrifice in the labor market. What this is going to set up is a trend for the non-farm payroll reports is headed negative, perhaps by the end of the year. And as it stands now, the BLS data shows the economy added 2.9 million jobs in the 12 months through March 2024, or on average about 242,000 per month. Even if the total revision is as high as a million, monthly job gains would average around 158,000. Still healthy pace of hiring, but a moderation from the post-pandemic peak. And it's not about the average number. That's what a lot of people want to look at here. What it is, it's about the trend. And the trend says we're headed into a recession. That means the Fed is going to cut here. But what I wanted you to see, it's not going to work. It's going to completely shock the markets all around the world because, again, everybody's pinning their hope on the recovery of a resilient U.S. consumer. We're about to find out the U.S. consumer is going to be staring down the unemployment line before long. And Powell and his colleagues have recently said they're focused more on the labor side of their dual mandate, and he'll take the benchmark revisions in account in his Friday speech at the Fed's annual symposium. And that's right, they're absolutely taking the labor market into perspective. We've been hearing that from Fed speakers all of a sudden, that they're growing concern about the U.S. labor market. And you have to think from their position as regional Fed presidents, they're talking to businesses in their area, and what are they hearing? The same thing we're seeing in the data. Fewer hours worked, people getting off their unemployment line, less demand in terms of new orders. They're worried they got this wrong, and this is going to validate it tomorrow. Because when we look at the consumer price index, there's this notion that you can bring prices down under control with monetary policy without impacting the labor market. But I want you to see, and I've just highlighted the pieces since 1970, but you go back and look and see the relationship is consistent. You can bring inflation down, but the key part here is in a debt-based economy. You're bringing demand down. So when you bring demand down, inevitably there are people that are going to be at the sacrifice of the reduced demand. That means fewer hours worked, fewer jobs needed. That's exactly what happens here. You'll notice in blue, you see the consumer price index head down. In red, we still have the unemployment rate. It goes higher. Now, sometimes it's with a lag. You'll see here that the CPI went up with the unemployment rate, but nevertheless, it remained relatively high, even as inflation came down. You see here going in 1980s, again, inflation peaks. Again, labor market comes falling apart. And every time after them, they start to get a little bit more in sync, suggesting that this recent decline in inflation wasn't because of the Fed. It had everything to do with a slowing jobs market that's about to get much worse. And here we can turn to Lowe's, who cuts their guidance on soft DIY spending and the housing market. And this is, again, just validation that the U.S. economy is headed in the wrong direction, that we aren't headed for a soft landing, that we're not at the beginning stages of a massive bull market, that we're in the early stages of recession, but investors don't want to believe this. They made the same mistake at the peak of the dot-com bubble. They made the same mistake at the peak of the global financial crisis. They said they never do it again, and yet right now they are. The retailer now expects comparable sales to fall 3.5% to 4%. Remember, that's not inflation adjusted. You can knock another 3% off of that. That's the worst than the average analyst estimated, as Lowe's now expects adjusted earnings to come in lighter than it previously forecast. It said it cut its forecast because consumers were spending less than expected. That means demand has come down. So again, remember, the Fed wanted to bring prices down but keep demand up. In this case, they didn't do it. We said they couldn't do it. Now you're seeing further evidence of that as they note that do-it-yourself projects as a macro and economic environment remains challenging, consumers not wanting to spend here. The company added it would continue to make inroads with professional customers in hopes that that keeps things going, but that will change as well. And Americans have pulled back on discretionary spending amid high interest rates and inflation, and they're holding off, and that's the belief here, on making large purchases or taking on construction projects that need financing, as they're prioritizing food and other essentials. Now, when you think about that, if someone said, I'm going to sacrifice doing some things I want because I need money for the things I need to do, which is food and essentials, it doesn't give you the indication of a strong and robust economy. It doesn't give you the indication that consumers believe that things are going to turn around. What it's telling you is they believe it's getting worse, and they're matching it with their spending. So again, as Lowe's customers start to disappear and spending goes down, well, that means Lowe's needs fewer employees. It all just back feeds on itself. And when they're shopping, consumers are being selective and seeking value, an indication that they can't afford items that are keeping up with inflation. Here, they're not seeing that at all. They cannot keep up with inflation. That this is dangerous. Again, everything now is pointing that the BLS should be giving us more accurate data. They're not. And in fact, investors are making decisions based on that false data. That's really the risk here. And tomorrow morning, they're about to find out that the money they're risking in the markets was not as good because the economy is not in the same shape as they expected. And we could see the unemployment rate heads higher. We know that's exactly what's happening at Lowe's, because when you have fewer customers, you need less hours and you don't need to give out big pay raises. And we see that here in the effect of total compensation growth. As we look at average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, we show that in blue on a year-over-year rate of change. And we can see that that deceleration in total compensation leads the unemployment rate every time. It was only a matter of time before we saw the unemployment rate tick up and non-farm payrolls get revised lower. The shocking part will be is when we just see by how much they're revised lower, because again, this is something markets around the world are not ready for at all. And rival Home Depot cut its full guidance last week, citing a deferral mindset as customers wait for interest rates to decline. But as we know, a decline in interest rates isn't going to change things at all for the labor market. It's not going to bring in more customers. In fact, when the Fed starts cutting rates, it means it's too little, too late for the economy, and it's game over. But one thing the Citibank now adds is that hedge funds are back doing the carry trade. Of course, what's notable is hedge funds don't really participate in carry trades. What they're trying to say is the dollar here is starting to weaken as people start piling on bets for a weaker dollar, noting that that's going to accelerate tomorrow when we find out how big the revisions are, because it's going to get everybody convinced that perhaps not just one cut may be necessary, but possibly two. And as we note, even though the Fed doesn't control the dollar, the market believes they do. That's why we're seeing bearish bets line up. But Citibank believes it's because they're borrowing them and speculating. Well, if that's true, watch out when this thing comes unwound, because we've seen our positioning sentiment on the US dollar start to turn more bearish as an environment where people are speculating about rate cuts has fueled risk appetite. And now hedge funds are using the strategy of picking the dollar over the yen as a funding currency, given the prospect of diverging rates in the US and Japan. What I think is happening here is hedge funds are actually starting to short the dollar as they believe that the US economy is going the wrong direction and the Fed will be forced to cut rates. But something we're bullish on is a sponsor for today's show is methane. You can find them on the CBOE Canada under the symbol ZEFI and on the OTCQB under symbol ZEFIF. And again, everything in the pinned comment and description below. Let's take a look, because what they do is eliminate methane emissions, they safeguard communities, and generate U.S. carbon offsets. As I touched on earlier, they make money three ways. And Zafiro has developed systems and expertise around detection and quantification of methane leaks at wellheads. And when leaking wells are found, they deploy their detection systems and perform statistical analysis to develop a sophisticated view of wellhead emissions. Their process has already been deployed across a number of projects and geographies with success in detection and quantification of significant leaks. Again, that's one way they make money. And when we look at other opportunities, they have orphan wells, and there are millions of them across 26 states. And this was as of 2020, and that means there's 280 to 500 million tons of CO2 equivalent offset potential, and it's going to cost 400 to 600 billion to fix the current problem. And that means, of course, Zafiro Methane keyed to do that, because one thing they do is plug wells in the US, and they are set to do that and take that challenge on in a big way. And that sets up the two ways they make money. Let's continue on, because they're an environmental services company specializing in methane abatement, and they're striving to be a key commercial force toward active sustainability. They're leveraging decades of operational expertise. They built a fully integrated operation to these environmental services via corporate, government, and the environmental markets. And as an originator of high-quality U.S.-based methane offset, Zafiro aims to lead the expansion that will drive even more capital into solving the orphan methane problem. And it's a big problem because there's millions of potential orphan methane sources across 26 states as of 2020, more than 500 million tons of CO2 equivalent emission reductions. And government funding covers only a small percentage of this problem, putting Zafiro in position to be a big provider to take care of this problem. And why is this urgent? Because methane is broadly considered as one of the worst emission sources for our climate. It's 25 to 84 times more potent than CO2 and makes up about 16% of global emissions. Atmospheric methane concentrations doubled over the last 2 centuries, and of course that means you're going to see governments clamp down and need this problem solved. Zafiro positioned to do that. And 29% of U.S. methane emissions come from energy industrial sources, and that is key because they're near where people live. So, the point is Zafiro cleans up the environment that we live in. And they also make money on carbon credits as a monetize methane reduction. They issue and sell methane abatement offsets. They develop recurring high-quality distribution channels, and they develop valuable market intelligence through new data streams to enable the scaled application of AI. They are key, not just as an environmental services company, but in the environmental markets. And here you can see some of their key growth drivers scaling to meet 2 large market opportunities. Their unique, fully integrated model provides competitive advantage. They've got regulatory environment provides a significant support for methane reduction, and their environmental markets is leading the charge to monetize methane reduction, and they have actionable mergers and application pipeline with multiple near-term opportunities. And here's the best part. They recently went on IPO'd in April of this year, and here's one of the best parts is they announced they've granted nearly 3 million of instead stock options to purchase common shares to officers, directors, and consultants. And these options have an exercise price below where Zafiro is trading today, giving you an opportunity to invest at a price less than the officers and executives who are highly motivated to drive the stock price higher over the years to come. Again, check them out in the pinned comment and description below on the CBOE Canada, under symbol ZEFI, and on the OTCQB under symbol ZEFIF. But as always with any company we feature on our show, you're under no obligation to purchase their stock if you do your own research before placing these trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.